Okay, well, we have another interesting panel on real estate, topic being alternative real estate, but all things real estate, and we'll see what our panelists want to talk about. I'm Ross Weiner. My company is called Gemsco Capital, private investment platform and advisory platform. I've been in the real estate business seemingly forever, since 1983. Done a lot of different things. Right now, we're doing investing and advising and also managing some money in the public markets. We've done a number of these panels over the last couple of years. One of the things I like to talk about in this is just sort of like from a 1,000-foot view, macro level. Where are we? Everybody wants to know, is it safe to go in the water for real estate? We did a panel a couple of months ago, and things have changed. A couple of months ago, it looked like inflation was coming down and interest rates were coming down. There were expectations that the Fed was going to cut interest rates 6 to 8 times. That was very unrealistic, and things have changed considerably since then. Now it looks like the Fed, if anything, will cut 1 or 2 times this year, or maybe not at all. Higher rates for longer. Inflation, instead of heading down to 2%, is heading back up towards 4%. And the expectation right now is that it's going to continue to head higher because of all the headwinds and things like commodity prices and oil prices. 2 things that I've been watching really are, the CPI, which, like I said, is annualized at 3.5%, up from 3.2 the last time, and interest rates, where if you look at where we were when we spoke in February, the 2-year was about 4.5%, the 10-year was 4.2. As of yesterday, the 2-year was pushing 5%, 10-year was 4.67, up about 50 basis points, and many people think it's heading to 5. And 5 would be really disastrous for real estate and the equity markets, frankly, in general. So that's kind of what I watch, and that just makes the environment more difficult for really any type of real estate investment. Doesn't make it impossible, but that's sort of my point of view, and I'd be curious to know from each of my panelists what they think in terms of how the macro environment is going to impact real estate investing and where they would go. So I'll let everybody introduce themselves as they take turns here. We'll start off with Kevin White, who just showed up. Kevin, I understand you have a new role. And
I do, and I usually don't sweat in front of a crowd, but I was over at 3rd Avenue, the place where we're having the conference tomorrow. When I showed up and no one was here, I realized that I'm in the wrong spot. So I made it from 3rd Avenue and 39th Street to here in about 18 minutes, so I'm sweating a little bit. So, Marty was putting pressure on me to get moving, but I'm too old to move that fast. So I do have a new role. My predecessor company is Spring Hill. I've spoken this once before. We are a family office backed investment company. Spent a lot of time I was at Lehman Brothers for 17 years, and we all know how that ended. I was a parajumper. I was thrown in the real estate group at the very end in 2008, and to quote, save the firm, and didn't do my job, I guess, right? So I think we all realize that you can't sell real estate that fast, and the risk was too much for the firm to handle. But lots of lessons learned along the way. Things that I would say was an expensive price for my freedom. So we ended up investing a lot in debt and structured debt from 2008 until we sold our last investment on March 6th of 2020, not knowing there was a pandemic, but that was the rhythm of the business. We have not invested a dollar since then. Spring Hill was sold to Wedbush. Wedbush is an LA-based investment bank. I'm going to be in charge of building out their asset management business. They have a wealth business with about 20 billion under management, and the real estate vertical is the first of the alternatives that we're going to be building up, but we'll do other things like credit and other venture capital. So that's kind of who I am right now. We again, we have a clean cloth. which we think is an asset today in these environments, meaning that no legacy people, no legacy assets, no legacy processes. And just given what the Fed's done in the last couple of years, it's just a matter of time before asset prices reflect the new rate environment, in our view.
Great, thanks, Kevin. Carol, it's good to see you again.
Yeah,
The panel. Why don't you take a shot?
surely. Well, my name is Carol Pepper. I am the founder and CEO of Pepper International, and for 23 years, I have built family offices around the globe, built them on 5 continents, and act as an external CIO to several large single-family offices that do a lot of real estate investing globally. Prior to that, I was at the Rockefeller Family Office, where I managed over $1 billion. And prior to that, I was at Solomon, JP Morgan, Credit Suisse, Morgan Stanley, the usual suspects, all in private wealth. I appear once a month on Bloomberg Television talking about the markets, and this is an interesting time in the markets. I would say that obviously Powell's signaling yesterday means we're going to have the brakes on and people are going to pause. See how long is this going to pause? Because if they don't lower the rates, the pain, as we all know, is going to get a lot harder for the real estate assets that are kind of holding on and waiting for that rate cut. So that's going to imply more discount. So obviously family offices that are not in any big rush are going to wait to see where the lay of the land is over the summer, I would say. I don't think anybody's going to be in a great hurry to buy anything today. I don't know what my fellow panelist thinks, but that's, our attitude is like kind of let's wait and see what happens. I personally think he ought to move that 2% inflation number up a bit. I think it's ridiculously low for a real economy that's actually working, but that's not my call. So we have to go with what he has. And what he's saying is he's going to wait. So we're going to have to wait.
Great, thanks. Andy Weiss?
Yes, well, thanks for including me, Marty and team. So my name is Andy Weiss. I have been on a couple panels with Marty before. I am a commercial real estate career person. I've been in commercial real estate finance for 35 years. I have my own firm called Sapphire Capital Group based in Bethesda, Maryland, and we raise debt and equity for commercial real estate deals, both acquisitions and then also development deals. The other thing I'll mention, which gives me sort of a national view, is I'm one of the 3 executive directors of a national collaborative of mortgage banking firms called CFBN, Commercial Finance Broker Network. So we have a call every other Wednesday with people from 35 different small boutique firms around the country, all going through the same issues and sharing a database. So everything that Carol that you said is true. It is a hard time to do a real estate deal. If you don't have to do one, most people are sitting on the sidelines. We end up getting engaged on deals where people either have found an off-market opportunity that is compelling, which I'll give a couple examples, or someone has a loan coming due and they don't have a choice, but they have to refinance. So when I talked to Ross, I said that the two things I would say as intro are the refinance market. So if someone has a loan coming due, you can't change the maturity date. So it's unfortunate that your loan may have been made when rates were at 3 or 4%. And today it's coming due when the new rates, depending on if it's stabilized or not stabilized, or what property type, or tertiary market versus primary market, your refinance could be anywhere from 6 to 12%, depending on what type of deal you have. So what does that create? That creates what I call, and a lot of people call it, the cash-in refinance. In the old days, people would refinance and pull equity out, and it would be a great event. Today, the cash-in refinance is a difficult problem to solve. So we spent a lot of time solving that, and there's definitely preferred equity and lots of people that see this as, even though there's a lot of negative things with rates being up, for the investors, it's sort of an opportunistic time, because someone could have a great property in a good location, nothing going wrong with the property, but the fact that interest rates went up and they had a $20 million loan and now they can only get a $15 million loan. Those borrowers typically want to go find, they don't have $5 million sitting around, so they want to go find, a $5 million investor, and that investor can, negotiate favorable terms and put themselves in what's most commonly lately is the preferred equity position, where they know that their last dollar of exposure is still going to be in a safe point, that they feel the property is worth more than that, and they're comfortable. and but they know they have 20% or 25% of equity behind them. So that's one. The other one I'll mention is the LP investors. So many, like sort of go back to again what Carol said, many of the either family offices or institutional funds that have raised a lot of equity, don't have to pull the trigger, don't have to put out their money. They want to, but they want to wait until it's a good deal. So the other trend that I've seen a lot is if an LP investor likes a real estate deal and they're willing to put up 90% of the equity or 80% of the equity, they can negotiate favorable terms to say, okay, I'll bring the 80% LP equity, but I also would like to be a co-GP with you. And that's the second theme that we've been very active in. I closed several of those last year. And a lot of times the sponsors, because leverage is more expensive, because leverage is lower and you need more equity, those owners still have good deals, but need more help on the equity side. So again, a lot of family offices and a lot of institutional investors are becoming an LP investor, but also a co-GP investor. So I don't know if that's enough, Ross, but those are some of the current things that I'm seeing, in the market.
That's a great overview, Andy. Thanks. Francis, you're new to this group. Why don't you introduce yourself? And
Sure. And thank you, Marty, for the invitation to join you and Ross. Yeah, my name is Francis Saele. I'm based in Cincinnati, where I'm currently providing consulting services to corporate occupiers in both their corporate real estate strategy and their evolving workplace. A really interesting area, and one that has a lot of occupiers with their hands up in the air, not really knowing what to do. My background has been all corporate real estate, mostly office and industrial properties as an owner, developer, corporate real estate executive. I developed properties in office on spec in 5 states, and handed some of those back to lenders, somewhat like what is beginning to occur here. So, Marty, or to Ross, to your question, my sense is that I think there's a lot of delusional beliefs about the fact that this cycle is similar to other cycles, but just been delayed because of the pandemic, and it's about ready to get back on track. I think the data that I put together, and I have a little show and tell, which if we want to go negative, we can show that, which I think will demonstrate that we're in a completely different world with respect specifically to office real estate. And we need to be able to figure out ways to protect those that we're advising. And maybe I should leave it there.
oh, certainly, I know the group here typically likes to hear about the dislocation in the office market, because that's probably where we see the most problems in real estate is office, for obvious reasons coming out of the pandemic, the low utilization and work from home and everything like that. And nobody really knows yet how that's going to play out long term, although everybody's got an opinion. And I know you've got some data to back it up. It's not all doom and gloom. Like Andy was saying, he's got a number of transactions that he's working on currently, and there's plenty of debt coming due that leaves opportunity for both lenders and for investors to get involved in some of these refinancings. In my case, I've been focused on some really alternative areas. I've talked about in the past single-family rental homes. I recently got involved in a mobile home park deal, which we're trying to put the equity together for, and real estate private credit lending, which is akin to some of the things that Andy talked about. So there's still a lot of cross currents, but recently the direction has gone a little bit negative. I pulled out some data on, just some anecdotal stuff on some of the deals. I mean, on the good news side, you get Blackstone, which is the 100-pound gorilla in the real estate business. Recently announced a $10 billion acquisition of a publicly traded apartment company called Apartment Income REIT. And Jonathan Gray's comment was, we're not waiting for the all clear sign. Now, not everybody can afford to say that. Blackstone can say that.
Mhm.
because they've got tons of money and market impact. But there've been a number of, office buildings, not just in New York, all over the country that have really, in terms of giving back keys, have really suffered. I've got a few written down here, like in St. Louis, there was an AT&T tower that apparently sold for something like $2 a foot, and which was about $3 million, and sold in 2006 for $205 million. And in New Jersey, got the Woodbridge Mall, that's 1.7 million square feet. In 2014, sold for $366 million, and this sold for $70 million recently. And bondholders lost $155 million. So there's going to be more of that to come, and I've got others listed here, but I don't want to scare anybody. So where would you guys, where would you guys go, Kevin? Where you've got a clean slate. Where do you want to focus?
The simple answer is we focus on debt because we don't believe there's any equity in the world right now, any current equity. So we think that the debt is the equity's been wiped out, and it's just a matter of time before the debt comes due and has to recycle. Much what Andy was saying, we're seeing it across the board. We looked at a building in Chicago where 2018 the bid was $110 million, the offer was 120. The sponsor had $70 million of equity for it. That building is trading for $20 million. So people will say, wow, $20 million on an asset that used to be worth 110, 120, that's really good, but it's 75% empty post-COVID. It burns $50,000 a month, and there's no really logical path as to where that goes. And so people are scratching their heads on, just because you can buy it cheap over replacement costs or cheap relative to what it was, what do you actually do with it? It's a head scratcher. I think that we're talking to banks. Banks, I think this go around are a little bit better positioned relative to markdowns or write-downs, based on the Dodd-Frank clause CECL, or the current expected credit losses. So they're actually taking some conservative views, and they're marking their loans or taking a reserve against their loans. So that's good. Andy made a good point where everything was cash out refi for 40 years, right? So when rates go from 1982 to 2022, rates went directionally down, right, from 20% to 0. So when rates go directionally down, asset prices go directionally up. So everyone's smart, right? So no one argues with that, right? So everyone's smart. Now you had an unprecedented Fed move, right? A rate of change that's never been faster. So anyone that had risk on, and especially levered risk on, is in trouble, right? So when we look at CMBS, or we look at the banks, or we look at CLOs, we think a lot of the CLOs have zero equity and wiped out. I think a lot of the CMBS is wiped out, the equity is wiped out, the mezz is wiped out. A lot of the AB is down to the A note. We're actually looking at a building. It's actually.
I'm talking office or
mostly office.
Is this only office, or we're not talking about multifamily?
Well, no, but so I think that when you boil it down, it's just math, right? So when rates go from 0 to 5, and cap rates go from 5 to 7, right? So that's a 20% destruction of value. And no one could argue with that, just math. Forget about the credit, forget about anything else. It's just math. And what people are doing is they're waiting until they run out of oxygen, right? So there are a lot of people that are running low on oxygen under the water, and they're going to start popping up. And we're starting to see those stress points in the system, and it's coming. And it's a big problem. And but it's just math.
so you're looking to buy the
Or
debt?
maybe they're waiting on the bailout.
Good luck to them, right? Waiting on the bailout. So when the government comes in and bails out like wealthy, developers, then I think that's like a massive outcry.
We've got a Steve McCarthy question over here.
Yeah, I was reading earlier that there's something like $3.1 trillion in property assets that can be refied by 2025. And they think
Hi,
that
guys, I just want to let you know I can't hear anything. I'm hearing garbled sounds.
Okay, I'll try better.
Carol.
I read where there's $3.1 trillion needed to be refied in the marketplace by the end of 2025, 3/4 of which is in the United States, residential and office. Are there any international buyers to come in, given the way that they think or the way the currencies are moving, that may be an opportunity for some of these people to get taken out by international buyers, whether they be from Europe, Middle East, Asia, et cetera. Is that something you're seeing, or is that an
It's like a
non-factor?
post 2008 scenario.
It's
where
a,
Korea
uh,
wanted to hold onto our buildings, right?
It's a great question, and one of the, and with that, there's lots of complexity. So a lot of the loans that were done right now, there is participation or syndicates. So if Citibank makes a loan and they'll syndicate it out to a bunch of Dutch banks or German banks or French banks. So now you have this syndication problem. So it looked great for a European lender back in 2018 to make a 60% loan to value on an office building on a $500 million loan. No one's going to question that judgment back then. Well, now that loan is 110 or 105% LTV, and now it's a workout. So the lenders right now have to turn their hats backwards and are doing workouts.
Carol, you do, I think, a lot of work with international clients. Do you have a view as to whether they're stepping in to help out with the $3.1 trillion of debt coming due over the next couple of years?
I think
She dropped off?
Yeah, she dropped out again, so.
And she's back.
Sorry, I don't know what's going on. I don't hear most of what you're saying.
Oh, it was just, I was asking you that, I think you work with international clients. Are they stepping in to, take some of the burden off of the debt, the debt cliff that's facing us, where there's $2 or $3 trillion of debt coming due, or is this an opportunity for the international buyer?
Yeah, I mean, the international buyers have a different calculus in the sense that they look for very long-term places to put their money safely. So they do like U.S. real estate, but they are looking actively, continuing to look actively at U.S. real estate. I would say though that they're not dumb buyers, so they're also well aware that there's distress coming, and that they're willing to wait a little bit to see how good of a price can they get. A good market example of that is Austin, where it's starting to leg down. Everything has slowed way down, even land in Austin. But at some point there'll be a bottom, and at that point people will step in. So I think it's really the calculus is at what price. I definitely see the international buyers still very, very eager to be here, still actively looking. They still like multifamily. And I do think they're getting very savvy about micro markets. So they'll look in, for example, where I live in New York, out where we are in Long Island in Suffolk County, it is booming. I mean, you can't get an apartment. There's tons of businesses. There's lots of people. It's lower market immigrant populations, but gosh, you're making a ton of money on that. So going to a micro market where they feel comfortable, they know the dynamics of that micro market, they're looking there and more willing to pull the trigger. Perhaps that in situations where they think, New York City, it's going to fall further, let's wait a little bit. But I don't think they're going anywhere. They're not saying forget US. They're just waiting for what's the right pain point to step in. Because they have a lot of cash. They're huge cash buyers. I will also mention, by the way, that there's a lot of opportunities right now in Mexico because of the nearshoring. So what's happening is Mexico is on fire. There are massive numbers of European companies, American companies moving their Asian operations to Mexico, particularly areas like Monterrey, and the building is nonstop. There's plenty of money sloshing around. Deals are getting done rapidly. So, that's another market that people can look at if they want to get something that's going to be huge over the next few years, because I don't think, frankly, China is going to change its stance. And I don't think we're going back to Asia as a major place for manufacturing. I think it's going to come over here to Mexico and stay there because they're really embracing that change and building a huge infrastructure to receive it. So for those who like to go outside of the US, that's a market to really look at. It's really growing quickly.
So Mike, I have a question, which is that, so people are talking about international, rescue, but is it any better in any other cities in the industrialized world than what it is in the United States right now for office? Is it better in Europe? And last time I heard, Europe had to reconfigure all of their office buildings to come into compliance with ESG sort of rulemaking. Is that any thoughts?
Oh, that's certainly another headwind. I'm not really well versed on European office markets.
I'm just saying that if you're a European family office and you're a real estate focused family office, maybe you're not looking to do more real estate.
Well, I think, it's one thing to stay away from office, but, as Carol pointed out, there are other areas that are quote unquote on fire or
Sure.
strong.
Sure.
I mean, housing, multifamily is still strong in the US. For sale housing, a little less so, just so there's no supply and there's very few transactions because they really need interest rates lower to unlock the ability of people to both sell and to buy. Because the sellers are still sitting on their 3% mortgages, so they're not sellers. And the buyers can't afford to buy because prices are still high, haven't come down because there's no sellers.
Right.
So it really depends. Retail's been relatively strong. The US consumer has been strong, although it's still a little bit unclear as to whether that strength where that strength is coming from and whether it's, how much of it is due to inflation, say.
Yes.
People just have to pay more.
Our comment on international is that, like, we don't know anything about international, right? So there's got to be someone smarter than me to talk about whether you're in Spain or UK or someone else. So real estate is a local business. And so if someone's asking me to make an investment in outside the United States, I'd have to pass to someone else who's better qualified than we are.
Right, so my discussion was, I don't believe there's gonna be a European rescue of American real estate, except for like the most trophy-like property, because it's not doing, if you're a real estate investor in Europe, it's not doing any better in Europe than it is here.
I would agree. I think that you'll see two things. I think the lenders are going to be in a workout that they don't want to be in, on the European lenders. And I think European families are definitely looking at the United States, which they always look at the United States to put money into to a stable asset, from a stable currency, and get it out of wherever they're living. So that phenomenon's not going to change. But Carol's point around Mexico, I don't dispute that for a second. We would never go to Mexico because I'd rather go to Cincinnati or Columbus or Cleveland, where we can control it. There's jurisdictional law. We know the asset. We can diligence it, and we don't take the risks of international whatever.
Aside from the lenders and the families, are there European public company or pension fund or corporate types that tend to overweight real estate and maybe look like a shell, for instance, or, companies like that may be opportunistic?
Didn't the Canadian pension fund buy a bunch of real estate and they really got hit hard by it?
Well, yes and yes, and there's plenty of Canadian, whether it's CPP or Case Depot. There's lots of European pension funds that are involved in the United States, both in equity and debt. The short answer is yes.
What is the real estate industry doing? The example that you gave earlier, where the building in Chicago that I don't remember what the vacancy was, 30 or 40%. And if this work from home phenomenon sort of continues, you're just not going to need, Goldman Sachs isn't going to need 30 floors in a building like they used to. They may only need 10. So what happens?
Well, it's a great question. That's kind of like the $1 million question. So if you just take it simply, right? Pre-COVID, there was a 5-day work week, or maybe it's a 4.5-day work week, because some people took off on Fridays and left.
Absolutely,
right?
sure. Yeah.
So there's a 4.5-day work week, right? Now it's a 1-day work week, right? Or 2-day work week, and they're trying to get it to let's just say in the perfect world, a 5-day work week, and we get it to a 4-day work week, right? That's still 1 day a week. That's 20% of unused real estate. So by definition, the demand equation for real estate goes down 20% across the board. So what does that happen? Now, not every real estate is getting cut at 20%. Some A's will perform well, and the C's will be dirt or renovation or reconstruction, but it's dirt value, less cleanup, a lot of them. If you can do it, because some of them are also protected because they're historical issues around it. So it's going to be, in my view, this is a multi-generational cleanup. It's not going to happen overnight. Look at what happened to malls 20 years ago. You go to some cities in the hinterlands, right, and they're still empty, right? It's not cleaned up yet. It's going to take. This is a 20-year cleanup. So and real estate's slow. Again, and I'm being optimistic.
And owners and developers are always overly optimistic. So part of the DNA.
Well, Andy brought
I just wanted to say a statement about what Kevin said earlier, which is that a lot of people don't want to take the nominal hit. In other words, so everybody still lives with the nominal value of what they did the financing on for their whatever real estate they own, right? But the minute you sell it, that markdown, you lose all the equity, as you just said. You might have a whole, domino set built around, of other financing built around around the equity you had before. It's a terrible ripple of things that can happen because you've lost all that equity, right?
Here's a real example, right?
Thank
So a real concrete example. So 1000 Wilshire, which is where Wedbush, our new owner is on the name, right? You've probably seen it on the 110.
I think it's a lovely building, yeah.
Lovely building. That building is 477,000 square feet. It traded in 2018 for $196 million and Service bought it. Okay, that's $415 a square foot. Okay, they financed it with 100. So let's round numbers. It's $200 million purchase price. They put $50 million of equity in and $150 million of debt. The debt was a first mortgage of $130 million, right? Split A and B, and $20 million of a mezzanine financing. Okay, that's the capital stack. 50 of equity, 20 of mezzanine, and 130 of a whole loan. The whole loan was split into an A and a B, and it's in a securitization right now. The last trade in LA was the Aon building in December, and it traded at $140 a square foot, down from 415 to 140. So apply that same math to that 1000 Wilshire. The assets were $66 million. The debts, the first mortgage, whole loan is the A is 65. So you've already wiped out your equity. You've already wiped out your mezzanine. You've already wiped out your B note. All right. So you're now down to your A note. Now, if you look at the remittance report on that asset and you go look at the securitization, it's still performing because Wedbush is paying until December of 25. So it's still going to be cash flow positive, but it's anything but cash flow positive. So what do you think what do you think Service is going to do? Do you think they're going to put money in, Andy, to refinance that loan? Or do they think they're going to walk? They're going to walk, right? Of course. Everyone's walking.
Yeah. So one thing I wanted is that 15 years ago, all the consulting firms moved to hoteling, right? I mean, they're white collar. Now everybody can do hoteling.
Right.
And so it's not just these consulting firms that have 10% of New York's population office. It's 80% of the white collar workers can do hoteling now, which is I mean, you guys have brought up already, but it's an interesting dilemma.
Well, and also
Hey, Ross, before we're done, I have two positive examples of deals in the US that are getting done that maybe I could share whenever we want to come back. Do that now?
Who wants to talk about
So I was thinking, it's harder to find deals that work, but two examples of deals that I closed in December and one I'm live on right now is student housing has been great, and student housing is a new property type that's been around for however many 30 years, 25 years. But in COVID, some universities ended up having less people on campus. So I have one client that's just focused on, and this group loves multifamily, but multifamily has been a phenomenon where if the seller doesn't need to sell, he's not going to sell. So the transaction volume is way down. So this group has been targeting student housing deals that are just slightly off. So maybe they were 3 miles from campus, and prior to COVID, they stayed filled with students. But once people living on campus went down, this property was still a fine property, but wasn't being fully occupied by students. So maybe transitioned to being half students, half non-students. So my group has been targeting buying those and converting right when the student leases roll, converting that from a gross lease per bed to a net lease per unit and just running it as multifamily. And I've closed 5 deals with them, and they're smaller deals. So I'm mostly going to, family office like investors for the equity and usually, bridge debt because they're buying it. They got to convert it to multi. Once it's converted, then they put, Fannie Freddie debt on it. So that's a niche that's been working that I've seen. The other niche that I'll mention, similar to a lot of the panels listed this morning on healthcare, is the whole senior housing into assisted living niche. So that's a niche for most of us on the call from our generation. You're probably, and we've all dealt with parents with it, you're probably going to be seeing more demand for that type of housing. And because construction rates are so high, the construction has been scaled down. And then the other thing that's created a little bit of distress and an opportunity is people that had those properties, maybe they weren't stabilized, maybe they just got hurt hard in COVID. So there's been some distress. So I have a group that has an operator that is experienced in the senior housing niche. They're just targeting, situations where someone has a loan coming due that they can't refinance, or locations that have a higher demand And because there hasn't been as much product built, you know, there's more demand than supply. So I figured I'd share a couple positive examples of real estate deals that still make sense in this new environment.
I have one to share as well. If my internet doesn't go out, I'm sorry, I'm in a hotel in LA and it just keeps going out on me. But I have a client who has fantastic track record in workforce housing. And he's developing has really very strong relationships with the government in Massachusetts and is developing some already full senior, workforce housing mixed use developments that are doing extremely well. And there's massive demand, and he's got more demand than he can handle. So anybody who's interested in workforce housing, let me know. I mean, there are experienced people with great track records who can fill up cash flowing apartments at reasonable rents, are doing extremely well. And these are market rents. These are not like Section 8 housing. These are market rent, but for workforce, teachers, firefighters, people that are, making $100,000 or so or less. So there are bright spots, but that's not, large commercial buildings. Those I think are going to die and get reborn at much lower valuations. And there are going to be a lot of write-offs. I think that's what's going to happen with a lot of them, especially outside of the first tier cities.
Marty, you have a question?
So what if, I have one, what about Sugi Capital out of Philadelphia? Right, so there's a Cal Berkeley guy and
Sumi Capital. What is it?
Sugi,
Oh,
S-U-G-I.
Sugi. I thought it was an invitation to Sugi.
You can look them up on LinkedIn. Middle 15% returns. REIT portfolio, $100 million from Julius Baer. As a REIT portfolio, what are the REITs they're investing in? They don't invest in any, very little office. It's, and there's 14 types of sectors you can invest in REITs. So they're very niche-y. Cell towers, data centers, cold storage, healthcare.
Those are all good.
Massive data centers, like all the ones that are going to be needed for AI powering. So that's, and they're doing great returns. They're managing 100 million. They're looking to, they're raising more family office capital. But I talked to the guy on the phone. I was like, wow, this is stunning that you're making those returns in this market today. But he says that REITs are kind of isolated because they tend to have a lot less leverage than the other types of than private equity real estate. And any thoughts on that?
Yeah, a couple of them. One, data centers, obviously a very strong area. And there's going to be a lot of activity, a lot of development activity in that sector. And it's basically a triple net kind of business. In terms of the public markets, I'm active in the public markets. I used to have a REIT-oriented fund. Now I just do it, as part of overall market activities. So I'm long, short, different sectors. And, if you look at like recently the past couple of weeks, the REIT sector as a sector is traded along with, this interest rates and inflation trade, which is down about 10%. But, you can pick your sectors that way. And there have been hot ones and not so hot ones. And then there are some sectors that offer, one of the panels earlier was talking about you can park your money at, high 4s or 5% in money market funds, which is really a good place to be if you don't know what to do with cash. And some of these REITs, throw off 6 to 10%, 11%, 12% dividends. And as long as they're not, you have to look at their balance sheets and see that they're not going to be in distress, but that's a good place to be. And that's
They're highly liquid also. I mean, you're not.
They are, but when there's when that liquidity dries up quickly, it dries up quickly. But they are more liquid than a real estate deal for sure. So.
I just think that when that something that isn't considered by the family office world a lot, and I'm sure Steve McCarthy agrees with me, is that there's a risk premium on duration.
Yeah.
Right. The longer you invest, the more you need to get returned. Right. There's value in having liquidity, even if it, as you said, if it dries up a bit,
Yeah, for sure. I mean, but it also gives you a good indication of, because it reacts faster than the private market. So you can get a sense as to what's out of favor, what's in favor, what's changing. And it helps me to inform, some of my views on private market investments. Anybody else want to weigh in? Francis, you want to talk about office some more and scare people or?
But I don't want to lose the, when's the cocktail
We
start?
do enough of that.
But-
I have a
but-
question.
I'm sorry?
No, go ahead. Go ahead.
No, are there any questions from the audience on Office? I mean, from my perspective, the biggest problem with Office is a continually reducing demand. We've never seen this in 100 years, where demand for office space has been going down since the beginning of the pandemic, and it continues to go down. We'll be negatively absorbing office space through this decade. And the data supports that. So, we can show that. Occupiers are just using less and less space for a variety of reasons, and that's going to change. So, I agree with others who have said that there is no equity anymore in office. It's all going to be reborn as something else. And maybe it's a community church. I don't know. But
Can I ask the question?
Well, I think a lot of it's going to be reborn as housing. It's going to
well,
be.
that's very difficult to do. Very,
It is very
very
difficult, but I don't
difficult,
think
expensive, and you're better off to start with a clean site.
Yeah, we're just not
Francis,
sitting down and redo it. Yeah,
I couldn't agree with you more. I mean, anyone who thinks that they're gonna convert an office building into housing, like I wish them well, that's a long putt, man. That is a long putt. That is a tough one.
What are
It's
some of
a
the
long
numbers?
process, and it's not necessarily less expensive for the final product.
No,
And then when you step back and look at it, building a brand new building with the optimal architecture and window
all the
lines and
systems, and
closets.
all that stuff.
So I've been through many exercises like that. I have a live one right now, great location in downtown DC, and spent time with the group. And
Well,
it
just
made
think about,
sense, but you couldn't raise the equity.
that's
and-
it.
And there's no question, they were going to be all in at roughly the same all-in basis as building a brand new building. So why would
Right.
you
So
want to
that's-
put equity?
Andy, you hit the nail on the head. It's like, who is gonna give you the money to do that, right? Now, there are a couple slow deer out there, right? I'm assuming they're already caught, right? The slow deer will eventually get caught. Eventually, you're gonna run out of money. Right? There's not enough money out there. I mean, there are a couple of people out there that will do that, but they're not gonna be around very long. We don't worry about that.
By the way, I don't think it's as pervasive as Francis says. I think it's really, there are some areas where it's doing extremely well office, right? I mean, in Miami and Fort Lauderdale and Palm Beach, there's no office available, right? What's really dying is retail. It's just being crushed. You drive by malls, even in South Florida, and a lot of them are half shut down. They put up, the walls that cover up the door that used to be there.
This thing here changed everything.
Yeah,
right? It changed everything, right? We saw it in retail, we see it in office. I mean, office, like I was at Lehman Brothers, when the World Trade Center was hit, right? And what do we do? Everyone, because the servers were on site, they built disaster recovery. That's how smart we were back then. So we had an office up in Armonk with a bunch of servers just in case our next building got hit too, right? Okay, I get it. That's a reaction. But now things are in the cloud. And people commute to the office to do what? To look on the computer. You don't have to do that anymore. You can take the office to you. So that whole dynamic, and the social stigma of, if someone asked me 15 years ago, where do you work? And I said, at home. You're like, oh, what a loser you are. You work at home? Like you can't even get an office job? Like you said, I mean, seriously, that was a stigma, right? Like I work at home. I work on this side, my home office. It's really cool. No, it's not really cool. But now people work from home because it's so easy. And you have Zooms, you have all this stuff. So the technology has rippled through everything. And by the way, it scares the heck out of me for data centers, because I don't know about you, but I'm not a PhD in what's going on in the clouds. And there's some smarty pants person in Silicon Valley that's going to disrupt the data that we know, and someone's going to be along data centers.
You'll still need air conditioning.
You'll see an air conditioning, and you need a bed to sleep, right? So multifamily is still come back to, you still need to go to bed.
Yeah, I'm just curious about the office conversion to housing. Given the fact that we got the interest rate environment, given the fact we've got the rental system, high rent across the board, is there some kind of incentive, whether it be public policy, public funds, something driven that would take the place of 95 Wall and say, we don't need, developers to do that. We get incentivized by government to knock down buildings or retrofit buildings for housing for working class people, or et cetera, et cetera.
A couple of
Yes,
things.
so I can give you one
I'm not
example.
talking about I'm a capitalist, by the way, but I'm just thinking that,
You had,
gotta solve the
before
problem.
COVID, you had opportunity zones, which was.
Yeah, opportunity zones, yeah.
Which obviously still exists. I haven't really heard much about lately. As far as, kind of government solutions or involvement is a general matter, the politicians are just not smart enough, but.
Okay.
Washington DC has one right now. So Washington DC has a new housing initiative. So for office buildings that are converted to residential, they will give you a 10-year tax abatement, and they'll give you a couple other incentives. There's a program when you sell an apartment building in DC called TOPA, Tenant Opportunity to Purchase Act. So the government gives you a one-time exemption from TOPA if you renovate an office building to multifamily. So DC actually did that. It's one of the good things DC did recently. But even with it, as I said before, running all the numbers, it's still virtually impossible to capitalize an office to residential conversion in DC.
That's true.
So
Are you seeing the slide or not?
Yes.
Yeah.
Go ahead. Go ahead,
We
Francis.
don't need to spend a lot of time here, but just a couple of things that we should see here. This is CoStar data. This is CoStar and Newmark data primarily. But you have to look through it and have it kind of refined here. If you look at this line here, which is the average size of the total lease portfolio, we've dropped off 20%, and the direction is downward. Okay. I mean, everybody will tell you that existing leases are being renewed or moved at a smaller footprint and for a shorter term. I mean, that's death in an office building business for sure. Just a couple of things here.
And there's tons of sublet space on the market too. I mean, I've heard
Well, here you go. This is sublease. Now, sublease, when the pandemic hit, doubled. It's up from 100 million to 200 million square feet. Now that seems to have stabilized, but that's a bit of a problem because that's leased space that's not counted as vacant, but most of it is. This is the thing that really has me a little concerned, is that, and this is Newmark data, that if you look at the time frame on the major leases across the country, and this is what they're tracking in the gateway cities, there were only 20%, 25% through the impact. That most of the impact on the lease rollovers is yet to come. And this slide is even more compelling if you look at the text up here, that the average term of the long-term lease, the 10, 15, 20-year term was 11.4 years. And there's 2.6 billion square feet here that's going to roll over at a smaller number. So you factor that into the equation, and that's the biggest driver of negative absorption I've ever seen. We've never had this environment, ever.
Yeah, but what that data tells you, the compelling tease of when you pull that data out is that the relationship between the landlord and the tenant is going to change, right? Because the relationship between the landlord and the tenant was always, hey, this is my rent, take it or leave it. And it's a 10-year deal, take it or leave it.
Right.
Now, your point that they're going to give equity to, if someone comes in with 250,000 square feet and I own the building, I'm going to give them part of the return. I'm going to give them part of the equity. The tenant is going to, I'm telling you what, this is going to happen.
You think they're going to value that? You think they're going to value that? I don't know. That's a stretch, I think.
Well, we'll come back and we'll talk about it in 5 years. I'll show you.
I have a question. I think everybody is talking about essentially, yeah, there is a event that's going to happen, but you guys are not talking about what is going to happen and how do we make money from it. So if you go back to 2008, the asset is going to have to reprice. And frankly, the banks and the structures and the special servicers, they're not going to come in and just deal with an empty building. So what are they going to do? They're going to do what a Trump used to do. He said, yeah, I'm broke, I'm bankrupt. You're going to have to pay me to stay to manage the building. So I think they're going to, essentially the assets will reprice the losses because you need somebody to manage these properties no matter what. So the opportunity is really to do what, a special servicing is a very valuable asset. That's what Berkshire went out and bought a special servicer for commercial mortgage-backed securities, right? Because they can do it. That's the opportunity. I don't think they're going to come in and raise these properties. They're going to be used some way, somehow. It's just going to have to be repriced. And that's good. Why is it bad?
It's going to take time.
It's going to take time. And by the way, they're going to buy time. They're going to buy time. We had low We had,
But Ron, what you're saying, I totally agree with you. It's gonna take time, but
Yeah.
someone has to pay for that.
of course,
Right.
the lenders actually are gonna have to pay for it.
Someone, well, the equity owners get wiped out, right?
Right.
And the
Yeah.
lender's gonna have to sell it at a discount. So if the market mechanism works, that's exactly what's gonna happen. Everything's gonna reprice. Because if I own this building, it used to be at $100, and I own it for 20, well, I can charge different rates, right? So I.
But you
competitive
still
advantage.
need operators. You need people who come in
Well, I get
and,
that, but assuming that the building was operated, right? So the operating function is just a clerical function.
no, you gotta release it, reposition
Well,
it.
that's that, but
I mean-
you own it at a cheaper basis by
course.
5x, then you have a competitive.
You
advantage
still
in the
have an
marketplace,
upside.
Right, so
You may be wiped out, but you still have an upside to sit there and try to
the
reposition.
the new owner, not the existing owner. The
Could be,
existing owner.
it could be the existing or the old.
The only way the existing owner keeps is if they find new money. It's cash in refi, right? To Andy's point, it's no longer cash out refi, it's cash in. Where are they gonna get the money? Someone has to lose. Someone's gonna lose.
The
But
banks.
if the equity, if
Banks
the
will
debt-
lose, the banks will write down, hopefully they won't get crushed and destroyed, but the banks are gonna lose. They're gonna do the write downs and then the new vulture buyers will come in and buy for cash. That's what's gonna happen.
At a low basis, at a much lower
Very
basis.
low, but it's gonna reset the basic value. The bank is
So-
gonna take the hit or up, you know what.
So-
You're gonna buy at a lower, you're gonna buy at a lower value, but there's no demand.
It's not wirehouses, though.
So are we saying this is not an opportunity, or are we saying this is an opportunity that we should really focus on and try to raise capital
But
around it?
it's, the difference between 08 and today is 08 was a shock, and it's immediate shock. Lehman goes bankrupt,
Yeah.
everything happened at once, right? So it was like a earthquake, right?
Yeah,
Just
yeah.
tectonic plate shift. What's happening now is all of these loans have a maturity schedule, and it's like a train going up the cliff. It's moving, and every single one of these loans are in motion. And they're closer to expiration tomorrow than they were today. But you can't stop it. It's like death, right? We're all on the same path. It's gonna happen. You can't stop it. It's every day you're gonna get closer. This is the reconciliation, and it's gonna happen.
But I mean, the Fed has proven time and time again that the more time that it has, the more it can hide stuff in a closet or something, right?
Well, they're saying it's not an interest rate problem, it's actually beyond that, it is the value has dropped so dramatically because the rents have dropped, the demand has dropped, they have to be repriced and repositioned.
Yeah, and we haven't even spoken about the fiscal impact of a lower real estate in cities like New York or San Francisco and Chicago that rely on this, and what does that do? That's why I said this is gonna be a 20-year problem.
Right, yeah, Chicago, Los Angeles.
Oh, it's a
New York,
disaster. All of a sudden you cut their budget in half because no real estate taxes are down? Because in San Francisco, it's like, cancel Christmas. This is really bad stuff.
Their budget, right?
But it's
There's a
not
guy
the same,
great-
but it's not the same for every property type. What I can't see the gentleman that's asking the
Oh,
question. What he's focused on is office, which is true, but still multifamily in certain markets.
Great job, guys.
Where are we
Thanks so
gonna
much.
put the robots? AI, let me put it there.